Hi everyone, so I'm here with Darren Joseph today, who is a specialist in expat taxation matters. I'm Adam Fayed, I run adamfayed.com, and we are an expat wealth management organization with clients in over 109 different countries.
Adam, it is an honor and a privilege to be speaking with you. My name is Darren Joseph from HEJ.tax. We're a team that seeks to demystify the sometimes confusing world of international tax. So we work with expats, location-independent entrepreneurs, nomads, so described, anyone basically who would describe themselves as a private client exposed to more than one jurisdiction.
It's a great point you make about documentation, because I see the same thing in my industry. So, for example, when people are actually going to invest, they need what is called a tax identification number, a TIN, right? It is possible, of course, if somebody lives in a country that doesn't tax income at the personal level, like the UAE or Monaco or whatever, to say, I've got a proof of address, and therefore you can put, I've got no TIN, and here's the proof I live in that jurisdiction. But then, of course, there are rules above that, like if you're just living there for 2 days of the year and you're flying in, of course, you could always be found out in this kind of world. But I've also noticed with clients and also running my own affairs globally now, a lot of jurisdictions are moving towards actually doing things like audited accounts and other things. For example, let's say the UAE, they're bringing in from this year 9% tax. That means it has to be paid next year for this year. But beyond that, if you're paying yourself $1 million of dividend, or $1 million of dividend is coming from anywhere in the world now, apparently, it's more likely that UAE entities or individuals, even a rich person who's acquired shares and dividend-paying assets, they've at least got to register themselves. Even if no tax is due on that, they've still got to register themselves, get the documents. And I've noticed the same thing with offshore banks. With my entities as well, if you can say, well, I can produce audited accounts, that has an effect on the bank. So I think even those low tax jurisdictions where you can pay almost nothing compliantly, they are moving towards just abiding by those international standards, right, at the OECD level.
Absolutely. And that is the case study everyone's talking about right now, what's going on in the UAE. And clearly under pressure from the OECD and being threatened by, they were taken off the blacklist and then they were put on the gray list, and they saw the writing on the wall and they say, well, you know, we don't really need it, but we need to put 9% in the first instance. And I think everyone knows that it's going to be pushed up in time, the corporate tax rate, because the global minimum tax, I think the consensus is somewhere around 15%. And it's just a matter of time till some sort of personal income tax. And as you pointed out, under some circumstances, because people were looking at that as a loophole, well, instead of passing it through my company and then paying 9% on the profit, I'm going to pull it all out as like a salary or some sort of bonus. And therefore, the company will have zero net income. And therefore, I won't pay the 9%. The UAE figured it out. And one of the subsequent decrees said, well, if it's $1 million dirham or more, which is 370,000 US dollars, the 9% would apply. So they're actively looking at plugging those so-called loopholes and becoming compliant with what is now the international norm.